if you bought the news, S&P, NASDAQ, like November the 6th, the day after the election, you had a massive upsurge. And November 5th and 6th, excuse me. The 2 days right after, you had this massive gap-up type surge. And the metals, monetary metals, did quite the opposite. Silver and gold are trading now back above the price level they were when people sold the news. So if you sold the news of the election, Trump's going to defeat inflation, all this, you're losing right now. Silver and gold are actually back above those levels. S&P and NASDAQ are above the levels where if you bought the news, you're still making some money. Not a lot, but you're making some money. But it's interesting, the monetary metals have regained that loss and are trading higher than they were post the election. I don't trust the Bitcoin move. I think it is highly correlated to NASDAQ 100. I think it is a bubble, and we have technical reasons to distrust this surge that went through 73,000. Oh, it's joyous. There's no question, but the sustainability of it is highly suspicious from our macro technical point of view. So we're doubters, okay? Not negative right now. We've got some levels below that will turn us negative, but I'm highly suspicious that it is almost impossible, frankly. Our long-term momentum of quarterly momentum of Bitcoin is in a position where if you keep going up, it's not going to confirm. You'd have to literally leave the earth to confirm it. And I don't think it will. Too many other the more intermediate metrics that we look at, intermediate trends, say, no, you're overbought, you're going to wobble, and you can't afford to wobble. This is a headline event. I like to link it to the tulip bulb mania. Okay, it is highly correlated to the other bubble out there, which is primarily it's U.S. stock market, but mainly the NASDAQ 100, which has been the leader index all the way up, and more than doubled what the S&P did since 2009, and it will lead the downside. And they're both, of course, beating their chest right now, especially post-election. And so I guess you buy the news, right? Okay, we shall see. I'm highly suspicious that by the end of this month, we will have a wobble, especially in the stock market. I think Bitcoin will likely reflect that. I don't mean to collapse, a wobble, a subtle wobble. Let's call it 4% or so off where you are right now. There's a problem with that. I'm talking NASDAQ and S&P right now. If you have that kind of wobble, that doesn't do any damage to the price charts, but our quarterly momentum is very eerie. When we look at the momentum of the S&P and the NASDAQ 100, yeah, you see the price doing this upward curvature thing. But when you look at momentum, you see a floor. It's been used and used and used. In fact, there's two floors on each. There's the upper floor and the second floor. But they're very close together. So it's like two sticks of dynamite. You drop back and close this month with a wobble. I don't mean it doesn't have to close down on the month. Just close back for example, I'll give you my best guesstimate. 5,800 on the S&P. It's only a couple hundred points below you right now. That's still up on the month, for example. NASDAQ 100, it's 20,700 is kind of my projected monthly close. That is, if we wobble just a teeny bit next week, I think you're going to probably see further oozing back by those indices. The problem then is, as soon as you open the next quarter and see the momentum structures, they would say, ooh, that's eerie. You don't want to go there. So anyway, I think we're setting up for that. Now, that also will have major wave effects on the monetary metals.
When we take a step back and assess the financial landscape, it becomes evident that we're navigating uncharted waters. As Michael Oliver explains, the dynamics at play, ranging from post-election market movements to the bubble-like behavior in equities, signal something much larger brewing beneath the surface. Oliver's nuanced perspective on monetary metals like gold and silver sheds light on their resurgence amidst the noise of stock market exuberance and speculative booms in other asset classes like Bitcoin. Let's dive deeper into what's driving this narrative. First, let's address the post-election phenomenon. If you were among those who bought into the S&P and NASDAQ on November 6th, immediately after the election, you likely experienced a sugar rush of gains. The markets surged, riding on optimism fueled by headlines and speculation about Trump's potential to tackle inflation. However, as Oliver pointed out, this optimism has been met with a harsh reality check. While equity markets have retained some gains, gold and silver, often viewed as hedges against uncertainty, have quietly reclaimed and surpassed their pre-election levels. This performance highlights a crucial point. Monetary metals are signaling something significant. They are reclaiming their role as reliable stores of value, in a world where speculative bubbles dominate the headlines. Gold and silver's rebound is a stark contrast to the volatile and highly speculative rally in Bitcoin, which Oliver compares to the tulip mania of centuries past. While Bitcoin has seen an impressive run, Oliver's technical analysis raises doubts about its sustainability, suggesting that this surge might not hold water for long. The comparison between monetary metals and assets like Bitcoin becomes even more striking when viewed through the lens of market dynamics. Bitcoin, often hailed as digital gold, remains tightly correlated with the Nasdaq 100, a tech-heavy index. This correlation raises questions about Bitcoin's independence as a store of value. It moves like a tech stock, benefiting from the same speculative fervor driving the Nasdaq. On the other hand, gold and silver are less tethered to such speculative bubbles, making them a more stable refuge for investors seeking to hedge against broader market risks. A wobble in the stock market seems almost inevitable. Oliver's analysis of momentum indicators, particularly in the S&P and NASDAQ, reveals a fragile foundation propped up by unsustainable policies and euphoria. He paints a vivid picture of a market on edge, teetering on the precipice of a minor correction, or worse, a larger breakdown. A 4% decline, while seemingly minor, could trigger cascading effects across various sectors, exposing the vulnerabilities of an overextended market. The financial sector, as represented by ETFs like XLF, adds another layer of concern. While tech stocks continue to lead the charge, financials, commercial real estate, and other key sectors show signs of weakness. Oliver emphasizes the precarious state of commercial real estate, a sector weighed down by debt and changing dynamics in the post-pandemic world. Office vacancies, shifting work habits, and declining demand are creating a perfect storm that threatens to ripple through the broader economy. This backdrop brings us to a critical juncture. What happens when the stock market bubble bursts? According to Oliver, this isn't a matter of if, but when. The bubble, fueled by years of monetary stimulus and zero interest rate policies, has embedded systemic errors in the economy. Families, companies, and governments have made decisions based on distorted financial realities. Once the market's technical underpinnings give way, these errors will come to light, leading to a cascade of corrections across various levels. And here lies the opportunity for monetary metals. Historically, gold and silver have served as safe havens during times of financial turmoil. When markets falter and central banks resort to panic-driven monetary expansion, these metals stand to benefit. Investors seeking stability will flock to gold and silver, driving their prices higher. This dynamic is not merely speculative. It's rooted in the historical performance of these assets during previous crises. Oliver's cautionary tale about the fragility of the current financial system serves as a wake-up call. Whether you're an investor, a policymaker, or an observer, the signs are clear. The era of easy money and speculative bubbles is nearing its end. As we delve into part 2, we'll explore how these dynamics might unfold and why gold and silver remain essential assets in an increasingly uncertain world.
We updated XLF, which includes bank stocks and also asset managers and insurance companies. And so it's the financial ETF, broad financial sector. And it's getting hit this week. The Nasdaq's up, S&P's up. The financials are down, and frankly, they're trading right now with a couple hours to go in the week below their a level that we didn't. If you close below it, it isn't a good sign. Okay, so despite the chest beating by certain narrow sectors within the market, particularly tech this time, Nvidia's popped back up again, not to its highs. It's still well off its high recently made. But you've had enough of a bounce to where Nasdaq is leading the charge this week. But look at the other sectors. Look at commercial real estate, RWR. It's a very vulnerable sector financially. Look at XLF. Why are they down? Why are T-bonds up? Anyway, you got to watch these things because these are the factors that ultimately will play in an enormous way. The debt problem is not going to go away. I'm talking the commercial debt primarily here. I think it's a bubble. I think it's the bubble. It's the headline chasing bubble. And I know there's a lot of positive assumptions about what Trump might do or can do, but At all. Okay, you scrutinize down the list of some of his appointees, you don't quite get this total free market thing or total change view. And now with Elon Musk and Vivek Ramaswamy, that's different. They're headed in the right direction. The problem is they can't simply dismantle this stuff. They can't just pull a plug and say, okay, it's over. They have to go to Congress to get approval on a lot of these things. It's going to be delayed. It's going to be fought. It's not going to be so easy as they think. And there's the other problem, and the problem would have existed no matter who got elected. We have a stock market bubble. It is the biggest stock market bubble in U.S. history. It's been going on since the 2009 low. And if you look at a money supply chart, you'll see why. Greater monetary growth in the last 10, 15 years than any other prior 10 or 15 years. And Fed funds rates during 10 of those 15 years have been at zero. So, they've been giving money away. So no wonder the market got fueled into a bubble. That bubble will break because it's created errors, embedded economic errors. Micro errors by individuals, families, companies. And usually that occurs once the stock market breaks its technicals. And we're saying right now, the technicals for massive breakage in the stock market are literally single-digit percents below, especially when we get into next quarter. And all you got to do is the rest of this quarter, then the remaining 3 weeks, is to see a minor wobble, and we're with the nooses around the neck. And it's at that point, then suddenly all the data metrics that the Fed likes to hang their hat on, they'll panic and therefore go what? Monetary expansion, all the panic methods they use. And that will benefit primarily what? The monetary metals.
The stock market bubble we're witnessing today is arguably the largest in U.S. history. This bubble, as Oliver points out, was not built on solid economic fundamentals, but on years of excessive monetary easing. Zero interest rates for over a decade, coupled with aggressive quantitative easing, have distorted asset valuations to levels far removed from reality. The S&P, NASDAQ, and tech stocks like NVIDIA and TESLA have become poster children for this speculative exuberance. Yet beneath the surface, cracks are forming. Oliver highlights how certain sectors, particularly financials and commercial real estate, are already showing signs of strain. The financial ETF XLF, which includes major banks and asset managers, is faltering despite the broader market's ascent. This divergence between sectors is a red flag, a sign that the foundation of the current rally is anything but stable. Commercial real estate in particular is a ticking time bomb. With office vacancies at historic highs and companies reevaluating their need for physical spaces, the sector faces a structural shift. Many buildings remain underutilized, and landlords are struggling to meet debt obligations. This strain will inevitably ripple through the banking system, which holds significant exposure to commercial real estate loans. The broader debt problem exacerbates these vulnerabilities. The U.S. federal debt has surpassed $36 trillion, with debt-to-GDP ratios nearing 130%. Historically, no country has sustained such levels without either hyperinflating its currency or outright defaulting. While the Federal Reserve and the government can delay the reckoning with monetary interventions, they cannot avoid it indefinitely. Oliver likens the current scenario to a game of musical chairs, where the music, sustained by artificial liquidity, will eventually stop. When it does, the fallout will be severe. Families, corporations, and governments that have relied on cheap credit will face harsh adjustments. This environment will only amplify the appeal of gold and silver, which have long been regarded as hedges against monetary mismanagement. Gold and silver offer something that no other asset class can: intrinsic value. Unlike fiat currencies, which can be printed ad infinitum, precious metals have a finite supply. This scarcity, coupled with their historical role as stores of value, positions them as reliable refuges during times of economic uncertainty. Oliver emphasizes how gold and silver have already reclaimed their losses from the post-election sell-off, outperforming other assets like Bitcoin. This recovery signals a broader trend. Investors are beginning to recognize the limitations of speculative bubbles and are shifting toward assets with enduring value. The resilience of monetary metals becomes even more apparent when viewed in the context of central bank policies. As the Federal Reserve faces mounting pressure to address economic imbalances, it will likely resort to the same tools it has always used: monetary easing and lower interest rates. These measures, while temporarily stabilizing markets, will further erode the purchasing power of the dollar and push investors toward gold and silver. While Bitcoin has been touted as digital gold, Oliver challenges this narrative. He highlights Bitcoin's tight correlation with the Nasdaq 100, suggesting that it behaves more like a speculative tech stock than a true store of value. The recent surge in Bitcoin's price, while impressive, lacks the sustainability and stability that characterize gold and silver. Bitcoin's reliance on speculative flows and its vulnerability to regulatory changes make it a far riskier bet. In contrast, gold and silver are not just assets. They are monetary metals with centuries of proven resilience. When markets wobble, as Oliver predicts they will, Bitcoin's speculative bubble could burst, leaving monetary metals as the ultimate beneficiaries. As the stock market teeters on the edge of a potential correction, the stage is set for a dramatic rebalancing. Oliver's momentum analysis suggests that even a minor wobble in the S&P or NASDAQ could trigger a cascade of technical sell signals. This correction would expose the fragility of the current rally and drive investors toward safer havens. Gold and silver stand to benefit immensely from this shift. Their historical performance during crises, combined with their intrinsic value, makes them natural choices for investors seeking stability. Moreover, as central banks around the world continue to accumulate gold, their actions signal a long-term belief in its value, a belief that retail investors would do well to heed. The implications of this rebalancing extend beyond individual portfolios. The broader economy, already burdened by debt and structural imbalances, will face significant challenges. Central banks, governments, and corporations will need to navigate a landscape where traditional tools like monetary easing lose their effectiveness. In such an environment, gold and silver offer a sense of security. They are not just assets, they are symbols of stability in a world increasingly defined by uncertainty. As Oliver aptly puts it, the monetary metals are regaining their rightful place in the financial ecosystem, a place that speculative bubbles and fiat currencies can never truly occupy. The appeal of gold and silver isn't just their historical stability, it's also their physical, tangible nature. In a world dominated by digital assets and abstract financial instruments, the idea of holding something real carries profound psychological value. It's a grounding force, a reminder that some things remain steadfast, even as the financial world becomes increasingly volatile. Furthermore, the global demand for precious metals is not just driven by individual investors. Governments and institutions around the world are increasing their reserves of gold, signaling a lack of confidence in the long-term viability of fiat currencies. This trend isn't isolated. It's part of a larger movement toward re-establishing trust in sound money. Central banks, particularly in emerging markets, have been aggressively buying gold to diversify their reserves away from the US dollar. This shift reflects a broader skepticism about the dollar's stability and the role of the US as a global economic leader. As countries like China and Russia continue to challenge the dominance of Western financial systems, gold emerges as a neutral, universally accepted asset. For retail investors, this global trend should serve as a wake-up call. If central banks, with their vast resources and access to information, are prioritizing gold, it's worth considering why. What do they know about the future of the financial system that the average investor might be overlooking? Moreover, the industrial demand for silver adds another layer of resilience to its value. Silver isn't just a monetary metal. It's also a critical component in various industries, from electronics to renewable energy. As the world shifts toward greener technologies, the demand for silver is poised to skyrocket, further bolstering its investment appeal. The narrative that Oliver presents isn't just about numbers and trends, it's about recognizing the larger forces at play. The world is undergoing a profound transformation, economically, politically, and technologically. In such times of change, gold and silver aren't just investments, they are anchors. For viewers and readers, the message is clear. Don't wait for the cracks in the system to become chasms. The time to act is now. Diversify your portfolio, hedge against uncertainty, and embrace the stability that gold and silver provide. These aren't just financial moves. They are steps toward securing your future in an unpredictable world. As we navigate this complex landscape, remember that history has a way of repeating itself. The lessons of the past are clear. In times of economic turmoil, those who hold gold and silver not only preserve their wealth, but often emerge stronger. So, whether you're a seasoned investor or just starting, consider the timeless wisdom of monetary metals. They've stood the test of time, and they'll continue to do so long after the speculative bubbles of today have burst.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.